Hi, thanks for tuning in again for another episode of Ask Spurrell CPA. Today we're talking about shareholder loan. I'm here with May. May, I think you might have seen some shareholders who are disciplined in their shareholder loan draws and some who are maybe a little undisciplined in the shareholder draws and take a little more, live beyond their means.
Yeah.
So the quote that we have here, for you concerning shareholder loans, Jim Collins, author of 6 business books, including Good to Great, which is one of my favorite, is a culture of discipline is not a principle of business, it's a principle of greatness. So the statistic that we have that ties in the shareholder loans is the average Canadian pays 43% of their income in taxes, tax, CPP, EI, GST, fuel tax, it never ends. And then by comparison, on average, the average Canadian is paying only 37% of their income for basic necessities, food, shelter, clothing. So it kind of gives you an idea of how significant tax is in terms of our life. And we don't often, consider it sometimes because we think that, hey, I bought a house for $500,000, that's the biggest expense. Well, what about, $40,000 a year every year till you die? It's gonna be bigger. And most people, they don't grasp that, but it usually ends up being the biggest expense of their entire life, and it's going to dwarf the cost of your house and your car several times over. So the story we have, they're business owners, and they're not sure how their shareholder loan account works, or they don't think it's really significant for tax, and they end up triggering significant tax payments because of what's in their shareholder loan. So May, what do you think these business owners should be asking in terms of understanding the shareholder loan account?
Well, the first question is, what happens when you draw money out of the company or get a personal benefit?
So when you draw money out of the company, it normally adds to your shareholder loan account. So business owners should get beyond the fact that they should be running all of their payments out as a regular employee. They should be using a shareholder loan account to exercise some efficient tax strategies. So when they draw money out initially, it should add to the shareholder loan account. So you take out $5,000 to live on in February, that means you now owe the company $5,000. The same thing as the company pays your personal mortgage for $1,500. Well, now you owe the company, say you took $5,000 to live off, the company paid your $1,500 personal mortgage payment, now you owe the company $6,500. So whenever money comes out, or you receive a personal benefit that the company pays for, it's a running total of what you now owe the company.
What if you contribute personal funds or pay corporate expenses personally?
Yeah, so let's go back to that same example where that business owner had taken out $5,000 to live on, and the business paid their $1,500 personal mortgage payment, and they owed the business $6,500. But what if in the month before that, the business owner put in $10,000 for that business to start? So really when you get a credit in the shareholder loan account. So let's say they started by putting $10,000 into the business account. So then when they took $5,000 out to live on, they now owe the business only $5,000. So it's a running balance. Every time you get money out, it's a debit. It adds the amount that you owe the company, and every time you put money in, it's a credit, and it basically it's going to reduce the amounts that that you owe the company, or it could create a scenario where the company owes you money. Okay.
How are shareholder loans owing to the corporation normally cleared?
So normally they're going to be cleared via salary and dividends. That business owner taking $5,000 a month to live on, the $60,000. They were taking it out because they need to live on it. They don't have another source of income other than their business. So they're not going to pay it back. That's not what's going to happen. Is we're going to declare salary or dividends to clear that amount. So normally what happens in order to clear that shareholder loan balance is we're going to declare personal salary or personal dividends, and that would declare it. So if we have $60,000 in draws for that individual, we can declare a dividend for $60,000 and bring that shareholder loan balance to zero, and we start from scratch, from square one all over again.
What happens to your personal taxes when you declare salary or dividends?
Yeah, so you declare dividends and you declare salary or dividends, and that's going to create a personal tax amount because those salary or dividends, they're going to be included on your personal tax return. So although they cleared the shareholder loan balance, now we owe personal tax on those salary or dividends.
Why is it difficult to review historical shareholder loan businesses?
The shareholder loan balances, yeah, they're really what the shareholder loan balances. You got to remember, it's a running total from the beginning of the business. So you get a new business owner, you're walking through year one, it's not so bad. Let's say you get a client and they come to you and the last accountant never met with them. They just emailed them reports and they weren't sure what's going on. And they ask you, can I get an accounting of my shareholder loan balance? Well, that would mean an accounting of your shareholder loan balance for the last decade since you've incorporated, transaction by transaction, line by line. The shareholder probably doesn't even, the owner of the business probably doesn't even have the general ledger or the receipts that deal with the ledger. Never mind remember any of the transactions that happened 7 or 8 years ago to determine if they're reasonable. So, it's something you need to stay on top of, because the exercise of going back, it's very difficult, if not impossible, to go back, because the shareholder's recollection on doing a reasonableness test, it's not there. They just don't remember what happened that length of time period.
Does monitoring your shareholder loan prevent unnecessary personal tax?
Yeah, 100%. You can have these amounts that are put in your shareholder loan account, and remember what's put in your shareholder loan account usually is going to trigger salary or dividends to clear that shareholder loan account. So if we're monitoring that shareholder loan account, we could catch something that maybe it's, hey, we thought it's $1,500. I go back to that $1,500 mortgage payment. What if that $1,500 was a payment on a business loan that the accountant didn't know about it? Okay, that now we've just avoided $1,500 in personal income, which is probably somewhere between 30 and 48%, depending on how much this business owner is making. So monitoring that shareholder loan account, like this is of all the accounts that are significant. Lots of times you can look at totals on the rest of the accounts, but your shareholder loan account, you should be looking line by line. And it shouldn't have that much stuff in it, because we shouldn't be running personal transactions through it. We should be taking one amount per month out every month and living off of that.
Does limiting the transaction in your shareholder loan account prevent errors?
Yeah, 100%. So you want to be limiting the amount of transactions in your shareholder loan account, because this is so significant for tax. We don't want to be making errors, and the way to reduce errors is to reduce the number of transactions. So the goal normally is for that shareholder to take one draw every month out of that account to meet their personal obligations. So they take one single draw every month, and maybe they have a planned personal tax payment every month, but that's it. So we look at that shareholder loan account, we see the one draw that we planned for, we see the one personal tax payment that we planned for, and we see nothing else. And that way, if we do see something else, it's one of 3 transactions now. And then we can determine, is this legitimate, or is this something that should be a business expense. But imagine if you have this shareholder loan account and you have 100 or 200 transactions a month, you're going to miss stuff. You're just going to miss stuff. So you don't want to be commingling those personal expenses. Get them out, get them to another account, and that's going to reduce the errors and reduce the chance that you're going to pay tax on something that you shouldn't pay tax for.
How long do you have to clear balances owing to the corporation?
So you have 2 years. So you can't owe your company for 2 consecutive years. You can owe your company for 1 year. So because people often ask us, like, well, salary or dividends, what happens? I don't want salary or dividends because I don't want to pay any personal taxes. Well, unfortunately, that's not the case. Everyone will just borrow money from their company forever. You have 2 years. You have to clear the balance from your corporation in 2 years. If not, it can be assessed personally. So you have 2 years to clear that balance, and it has to be cleared, unfortunately.
And does that 2-year window to clear a shareholder loan provide planning opportunities?
It does. It provides a significant amount of planning opportunities in terms of smoothing out the income. So let's say you're a business owner and you're purchasing a house in year 1, but in year 2, you're not going to purchase another house. So you got to take a bunch of money out of your company to purchase this house, you're going to get married and the wedding's expensive or whatever it is, but you have some sort of, one-time event and you, or maybe business slowed down later on. And for whatever reason, you're taking more money out in one period than the next. Well, we don't need to pay all of the tax on that in period one. We can spread it out into period two. And the beauty of that is the more you take out in any period, the higher rate of tax you're going to pay. So the more we can smooth out that income over time rather than declaring a high income one year and a low income next year. Really effective tax planning is normally we're hitting that middle range, so we're using the maximum amount of those marginal rates. We're always trying to avoid those amounts at the high end of the tax rate spectrum. We can often reduce taxes, pretty significantly. 2 years is a long time. We can look at, corporate year ends. Often that personal tax isn't even due on those amounts for more than 2 years because we have to declare the salary or dividend by the end of year two, but then, we have until April after that often to pay the personal taxes. So there's a lot of things that we can do in spreading out those tax balances to either give you a longer time horizon to pay and even possibly reduce the amount that you have to pay altogether.
And can personal tax be automatically assessed if you don't clear the shareholder loan?
Yeah, so if you want to roll the dice on the shareholder loan and you don't want to pay it off by the second year, it can just be added to your personal return. CRA doesn't need any permission to do it. If they find out that shareholder loan balance is outstanding for more than 1 year, so on that second year again, they can add it. And quite frankly, they can add it to whatever year that they see fit, whether that be the opportune year or not. So that's kind of the Russian roulette of taxes is seeing if you want to push the envelope on that, declaring the shareholder balance every 2 years. It's not recommended because that's just going to get added to your personal tax return, and not necessarily in the form that you wanted, in the form of salary or dividends, and not necessarily in the period that you wanted either. So it's better for you to declare it in either salary or dividends or the period that makes sense to you, rather than run the risk of CRA imposing it for you. So that's what we have here today concerning shareholder loans. Thanks so much for tuning in. As always, hit the like and subscribe button so we can continue to deliver you tips on how to beat the odds at business. And if you have any questions, leave them in the comments below and we'll do our best to address them in future videos. Thanks very much.